Welcome to Akesha's Foreign Exchange Made Easy class. Today is 31st session. Last day I have discussed convenience yield, contango, backwardation and basis. Today I will discuss equity derivative, strategy in overvalued and undervalued situation in future market and arbitrageur gain. Now come future market. If future market, if future price is higher than fair or theoretical price, then it is overvalued. In respect of future on stock, and strategy will be buy share and sell future contract. If future price is lower than the fair or theoretical price, then it is undervalued in respect of a future on stock, and the strategy will be sell share and buy future contract. You know what is fair or theoretical price as per cash and carry model. Fair price is equal to spot price plus cost of carry minus inflow. Inflow means dividend in the case of equity share or interest in the case of bond, and then this fair price will be compared with the future price, and if the future price is higher than the fair price, then it is called overvalued, and strategy will be buy share and sell future contract. Now reverse, if the future price is lower or fair price is higher than the future price, then it is undervalued, and the strategy will be sell share and buy future contract in equity derivative. In equity derivative, the arbitrage opportunity exists in future market. Arbitrage is a process of identifying a gap between the price in cash market and its corresponding price in future market. Equity arbitrage funds seek to identify this spread between spot price and future price and attempt to capture it in an efficient risk-free manner. In currency derivative, the opportunity of arbitrage exists, which is discussed in foreign exchange class 10. You see it how the arbitrager gain in currency derivative. Arbitrage occupies a prominent position in the future market as a mechanism that keeps the prices of future contract aligned properly with prices of the underlying asset. The objective of arbitrager is to make profit without taking risk, but complexity of activity is such that it may result in losses as well. Now a problem. As on April 1, 2023, cash market price of share is 2000 and June future is rupees 2100. Number of shares in one lot is 100. Cost of carry is 9% per annum, that is 0.75% per month. So there is a 3 months lag, that is April, May, June. Now we have to find out the theoretical price or fair price of June future is equal to 2000 into e to the power RT. Here R is equal to 0.0075 and 3 is the month. That comes to rupees 2045.51. Now it compared with the future price, spot future price. Spot future price is 2100. So it is less than the June future price. So it is overvalued. To take advantage of mispricing, an arbitrager may buy 100 share because the strategy is buy share and sell future. So he will buy 100 shares and sell one future contract. The lot size is 100. On that debt at given prices. He will borrow rupees 2000 to buy one share and hold it for 3 months. So the interest will be for 3 months per annum, 9% per annum will be 2000, and total amount to be repaid will be 2000 into e to the power RT, that is 0.0075 into 3, that comes to rupees 2045.51. Now the arbitrageur profit for 100 share will be 2100, that is spot future price, minus buying price is rupees 2045.51, which is less than 2100, since it is selling the future. So profit will be rupees 5499, which is the difference between the actual and fair price for 100 shares, and it will remain same in various scenarios of stock prices on the expiry date. If case 1, if the stock price rises to rupees 2100 on expiry date, so the strategy is buy share and sell future. Now you have to find out the profit on buying transaction. You buy the share at rupees 2000 and sell it higher 2180 into 100 share lot size is equal to 18,000. Loss on future, because it is sell, 2180 is higher than the spot future price, so there is a loss of rupees 8000. The gain will be 18,000 minus 8,000 is equal to rupees 10,000. Now cost of financing, that is the interest, will be deducted. The interest is rupees 2045.51 minus 2000 into 100 is equal to rupees 4551. Net gain will be 10,000 minus 4551 is equal to rupees 5449, which is same shown above. So whatever the scenario, the stock price, the profit will be the same. Now come to the case 2. If the stock price falls to rupees 1950 on the expiry date, then loss will be there in buying transaction, because buying price is 2000 and selling price is 1950 into 100, that is equal to rupees 5000. And here profit, because it is selling short future, the spot future price is higher than the expiry date future price, so profit will be 15,000. Net will be 10,000, and you deduct interest from it, it will be rupees 5449. When the future price is less than the theoretical price, then it is undervalued. The strategy of the investor will be sell share and buy future in the undervalued, and overvalued buy share and sell future. Now, as on April 1, 2023, cash market price of share is rupees 200 and spot future price after 3 months is rupees 180. Lot size is 250 share. Strategy will be sell share and buy future. If you find that cash market price is higher than the future price, then you apply the reverse cash and carry model. Here you will see that in the first case, the stock price rises to rupees 220 on expiry date. So there will be the loss on selling, because selling price is 200 and buying price is 220 into lot size rupees 5000 is the total loss. Profit on future 220, it is buy future, so expiry date price is higher than on a spot future price, so 10,000 will be the profit. Net gain will be 5,000. Here since it is sell shares, so no interest will be incurred for buying and holding it up to the expiry date. Case 2. Stock price falls to rupees 170. Profit on selling is rupees 200 minus 170 into 250 is equal to 7500. Loss on future 180 minus 170, because it is buy future, so 180 the spot future price is higher than the expiry date future price, so loss is 2500, the net gain is rupees 5000. Next problem, share of XYZ Limited are being traded at rupees 600. 3 months future contract rate is rupees 636 per share for a lot size of 500 share. Assume risk-free interest rate is 9% per annum, no interim dividend. What will be the strategy for an investor if the 3 months future contract rate is rupees 600? Now spot price is rupees 600, rate of interest 9%, and period is 3 months, that is 0.25 year. Theoretical 3 month future price is spot price into e to the power RT, that is equal to 600 into 1.0227 is equal to 613.62. Now you compare with the future price. Now case 1, spot future price after 3 months is rupees 636. You see, now you compare it and you find that the spot future price 636 is higher than 613.62, that is the fair price, so it is overvalued. The strategy will be the overvalued. It is overvalued, and strategy will be the buy spot and sell future. Now case 2, if the future price after 3 months is rupees 600, the theoretical future price is rupees 613.62, which is higher than the spot future price, so it is undervalued. Hence the strategy will be sell spot and buy future. Now problem is compute the theoretical price for following securities for 2 months, 3 months and 4 months, that dividend receivable. In the case of equity share, 2 months, 3 months and 4 months, and what will be the strategy of an investor for the future contract. Here it is, data is given. Securities of ABC Limited, XYZ Limited and PQR Limited. Spot price is rupees 5000, rupees 400 and rupees 950. Dividend expected rupees 50, rupees 20 and rupees 50. Dividend receivable 2 month, 3 month and 4 month. 6 month future price, it is 5070, rupees 430 and rupees 1020. Now when dividend is expected, then you have to find out the present value of dividend, and it will be deducted from the spot price, because as per cash and carry model, spot minus inflow, that is adjusted spot price. You have to find out the fair price for 6 months utilizing the adjusted spot price. Then you compare it with the future price. Now assume that the risk-free interest rate is 9% per annum. Now spot price for ABC rupees 5000, rupees 400 and 950. Dividend expected rupees 50, rupees 20, rupees 50. Now dividend receivable is 2 months, that is 1/6, that is equal to 0.1667 year. Here it is 3 months, that is 0.25 year. Here it is 4 months, so 0.333 year. Now present value of dividend will be dividend into e to the power minus RT. Here dividend is 50 and e to the power minus R is equal to 0.9% into T is 0.1667. That is equal to 50 by 50 into e to the power 0.015. Here you have to compute this present value, either of these. You find out e to the power minus 0.015 is equal to 0.9851. So you multiplied 50 with 0.9851, you will get 49.256 if you multiplied it. And if you find out the e to the power 0.015 is equal to 1.015, you divide it, because 50 into e to the power minus RT is equal to 50 by e to the power RT. If you divide it, it will give the same result, 49.256. So you use any of this method. Now in the second case, you convert it to the present value of the dividend, rupees 20 is equal to 19.556. Here it is, the present value is 48.525. Next, to find out the adjusted spot price. Here it will be 5,000 spot price minus dividend. Present value of dividend, it will give 4,950.744. Here 400 minus 19.556 is equal to 380.444. Here it will be 901.475. Now you find out the theoretical price after 6 months. Adjusted spot price into e to the power RT. Here T is equal to 0.5 because it is 6 months. Here you see that the fair price is 5,178.47. Here it is 397.94. Here it is 942.94. Now you compare it. Now spot future price is rupees 5,070, rupees 430 and 1,020. Now theoretical price 5,178.47, which is higher than the future price, spot future price, or spot future price is less than the fair price. So it is undervalued. The strategy will be sell spot and buy future. Next, here the theoretical price is 397.94 and spot future price is 430, which is higher than the theoretical price, so it is overvalued. And the strategy will be buy spot and sell future. Here you see the theoretical price is 942.94 and future price is 1020. So future price is higher than the theoretical price, so it is overvalued. Strategy will be buy spot and sell future. Now how the arbitrageur gain in the strategy is given below. Let lot size is 100. Spot price is 5,400 and 950. 6 month future price is 5,070, 430 and 1,020. Total amount of loan to be repaid. Here it is the strategy is sell spot, so no loan. Here it is buy spot, so loan is taken for to buy one share, rupees 400, and total amount to be paid after 6 months, that is for e to the power r into t, 0.9% into 0.50, it comes 418.40 per share. And here it will be 950 e to the power RT is equal to 993.70. Now dividend, here for selling dividend is not counted, and for buying 20 and 50. Now profit and loss will be there. Here the 6 month future price is rupees 5,070, which is higher than the 5,000. So there is a loss of 70, and for 100 share, lot of 100, the loss will be 7,000. Here you see it is important. 430 is the 6-month future price and 418.48, that is the total amount repaid after 6 months minus dividend. Dividend is 20. So 430 minus 398.40 is equal to 31.60, and for 100 lot, that is the rupees 3,160 will be the profit. Here you see 1020 is the 6-month future price. Here sell future, so 993.70 minus dividend, so 1020 minus 943.70 is equal to 76.30. Here it will be 7,630 for 100 share. Because it is for the second and third case, the sell future means the future price, the expiry date price is lower than the spot future price, then profit will be there. And this profit 3,160 and 7,630 and loss 7,000 will remain same in various scenarios on the expiry date. Let us take the example. Position of arbitrageur in various scenarios of stock price would be as follows. Let the lot size is 100. Let spot price on expiry date is 4,800, 450 and 920. Current spot price 5,000, 400 and 950. Spot future price after 6 months 5,070 and 430 and 1,020. Now let the loss on profit on transaction. For first case, the current spot price is 5,000 minus 4,800 into 100. The profit will be 20,000 because it is sell the share and buy the future. So it is selling price is higher than the expiry date future price, expiry date price. So 5,000 minus 4,800 into 100, it is 20,000 the profit. Now on future contract, 5,070 minus 4,800 because it is buy future. So spot future price is higher than the expiry date future price. So loss will be 27,000 for 100 share. So net gain or loss will be 7,000. Come to the second case. Now profit and loss, here buy share and sell future. Now buy share means 450 is the expiry date future price minus 400 minus 20, spot price minus 20 is the dividend into 100, the profit will be 7,000. Now in future contract, the loss will be 450. It is sell future, so spot future is higher than the expiry date future price is higher than the spot future price, so there is a loss of 2,000. So net gain will be 5,000. And here it come same case, 920 minus 950 minus 50 into 100, so profit will be 2,000, and 1,020 minus 920 into 100, it will be profit will be 10,000 because it is sell future. The spot future price is 1,020 and the expiry date future price is 920. So there will be the profit of 10,000. The total profit will be 12,000. The interest, you will count the interest. First case nil. Second case 400 into e to the power 9% into 0.50 is minus 400 the interest will be 18.40 per share. So for 100 share it will be 1840. You deduct it, 5000 minus interest, it will be 3160. Here you come here, the interest will be the 993.70 minus 950 is equal to 43.70 into 100 is equal to 4370. Now you deduct the from profit 12,000 minus 4,300, it will be 7,630. You see these figure are same which I have computed earlier, that is 7,000, 3,160 and 7,630. Because the various scenarios of stock price, this will be the same. Now one question may arise that in the first case, the sell spot and buy future, because it is undervalued, the loss is rupees 7,000. And if the strategy follow buy spot and sell future, then what will happen? That is, loss will be more than 7,000, which is shown in the following table. Now given current spot price is 5,000 and spot price is on expiry date is rupees 4,800 and spot future price is rupees 5,070. Strategy is buy spot and sell future. Here it is undervalued, so strategy will be the sell spot and buy future. Because it shows negative, that is loss, so I have shown the if you take the strategy buy spot and sell future, the loss will be higher than the rupees 7,000. Now loss in buying, that is 4,800 minus 5,000 minus 50. Here dividend will be deducted, that is equal to 15,000 will be the loss. And profit on the future contract, 4,800 minus 5,070 is equal to 27,000 is the profit, because it is the sell future. So expiry date price is less than the spot future price, so there is a profit and the amount is 27,000. The gain is rupees 27,000 minus 15,000 is equal to rupees 12,000. Now interest on buying one share, here you buy the share, so interest will be incurred, that is 5,000 into e to the power RT minus 5,000 is equal to 5230 minus 5,000 is equal to 230 per share. Now interest for 100 share is equal to 230 into 100, that is 23,000. Now total loss will be minus 23,000 plus 12,000 is equal to minus 11,000. This 11,000 loss is higher than the loss of 7,000. So the strategy of sell spot and buy future is ideal for the undervalued situation. Today I stop the class here. Next day I will start the equity shares, risks on equity shares, and also the systematic risks and unsystematic risks. Thank you.